A guy named Marcus in Scottsdale owns a $42,000 camera rig. He uses it for his business. And every single month, he writes his own business a check for $380 to rent that camera that he already owns. That is not a typo. That is not a mistake. That is a tax strategy the wealthy have been using for decades. And nobody in any personal finance class ever told you it existed. Here is why that matters to you directly. Every dollar Marcus's business pays in rent is a deductible business expense. That money leaves the business before taxes hit it. But here is the twist. Marcus receives that rent money personally. And under the Augusta Rule, which is a real section of the United States Tax Code, Section 280A, he owes zero federal income tax on up to 14 days of rental income per year. He is paying himself, writing it off on one side, and collecting it tax-free on the other. This is not a loophole someone found by accident. This is architecture. This is how the tax code was deliberately built to reward people who understand it. And right now, most people working 9-to-5 jobs are paying every dollar of tax they legally owe because nobody showed them the blueprint. Let's talk about what is actually happening here so you see the full picture. Marcus bought that camera rig as a personal asset. He owns it, but his LLC, his separate business entity, needs equipment to operate. So instead of the business buying the equipment, Marcus rents it out. The business pays him a fair market rental rate. Let's say $380 a month. Over 12 months that is $4,560 leaving the business as an expense. That reduces the business's taxable income by $4,560. If Marcus's business is taxed at a 25% effective rate, that is over $1,100 in tax savings just from that one asset. Now here is the second layer. Marcus receives $4,560 personally. But because the IRS allows individuals to rent their personal property for up to 14 days per year without reporting that income at all, a portion of that rental income disappears completely from his personal tax return. Legally, quietly, in plain sight. The Augusta Rule got its name because homeowners near the Augusta National Golf Club would rent their homes during the Masters tournament for enormous sums. Congress decided not to tax that. And in doing so, they accidentally handed every small business owner in America a weapon most of them never pick up. If this surprised you, subscribe right now. Because this channel exists to cover exactly what the financial media ignores. The strategies that are legal, documented, and sitting inside the tax code waiting for someone to actually read it. Now here is the deeper layer. And this is where it gets genuinely uncomfortable. The reason you never learned this is not because it is complicated. It is not. A good CPA can set this up in an afternoon. The reason you never learned this is because the tax code was written by people who already had assets. It rewards asset ownership. It punishes wage income. Every structure inside the code, from depreciation to rental deductions to capital gains rates, exists because people with assets lobbied for those protections over decades. A salaried employee making $90,000 a year pays taxes on every dollar before they see it. They get almost nothing back. A business owner making $90,000 can route money through entities, rent their own equipment, hire their spouse, deduct their home office, and potentially cut their effective tax rate nearly in half. Same income, completely different outcome. The difference is not income. The difference is structure. This is why self-made millionaires obsess over entity structure before they obsess over income. They understand that how money flows matters more than how much money comes in. And rental arrangements between personal assets and business entities are one of the cleanest examples of that principle working in real life. So what can you actually do with this? First, take an honest inventory of what you own that has legitimate business use. A laptop, a vehicle, a camera, a drone, a spare room, audio equipment, a trailer. If any of it is used for a business you own or operate, even a side business, there is a rental arrangement worth exploring. Second, get a CPA who works with small business owners, not just someone who files W-2s. You want someone who thinks in terms of strategy, not just compliance. Ask them specifically about Section 280A and equipment rental agreements between you personally and your LLC. Third, document everything properly. The rental rate must be fair market value. You can check what similar equipment rents for on sites like Fat Llama or ShareGrid. The agreement must be in writing. The business must actually pay you. This has to be real. Sloppy documentation is what turns a legal strategy into an audit risk. Fourth, understand the 14-day rule precisely. 14 days of rental income per year to a personal residence or personal property can be excluded from your income entirely. Beyond 14 days, you start reporting it. Your CPA will help you structure the number of rental days correctly. None of this is exotic. None of this is offshore. None of this requires being a millionaire first. It requires having a business entity, owning at least one legitimate asset, and understanding a section of the tax code that has been sitting there since 1976. Marcus is not a financial genius. He is not connected. He just found a CPA who showed him that the rules apply differently depending on how you play them. And now he is keeping an extra $1,100 a year just from one camera. Multiply that across a vehicle, a home office, and 3 pieces of equipment, and you are talking about real money shifting in your direction every single year. The tax code is long and brutal and deliberately written in language that discourages most people from reading it. That is not an accident. Stay on this channel, because we are going to keep reading it for you.